This is a balance sheet. JP Morgan Chase's balance sheet, to be exact, the one they file with the SEC every quarter. Right here on page 14, you can see their total assets, $3.9 trillion. That's deposits, loans, securities, real estate, everything the bank owns. It's one of the largest balance sheets of any corporation in human history. But flip to page 87, to the footnotes, to the section labeled Off-Balance Sheet Arrangements and Contractual Obligations. There's a number there that doesn't appear on CNBC, that analysts rarely mention, that most shareholders have never seen. $58 trillion. That's JP Morgan's notional derivatives exposure. $58 trillion. 15 times their total assets. More than twice the entire GDP of the United States, sitting in a footnote, treated as an afterthought. And JP Morgan isn't even the most exposed. When you add Goldman Sachs, Citigroup, Bank of America, and Wells Fargo, the total reaches $67 trillion in derivatives exposure concentrated in 5 institutions. 5 banks. $67 trillion. Hidden in footnotes across quarterly filings that almost no one reads. This is not about banks being profitable or well capitalized. This is about a financial structure so leveraged, so interconnected, so dependent on assumptions that have never been tested, that the people who built it have no idea what happens when those assumptions fail. Here's what they're not telling you. A derivative is a bet. That's all it is. A contract between two parties that derives its value from something else. A stock price, an interest rate, a currency exchange rate, the price of oil. The contract itself has no intrinsic value. It's a piece of paper that says, if X happens, you pay me. If Y happens, I pay you. For 50 years, derivatives were used for hedging. A farmer worried about wheat prices falling would enter a futures contract to lock in today's price. An airline worried about fuel costs rising would buy options to cap their exposure. The derivative offset a real-world risk. It made the economy more stable, not less. Then Wall Street discovered that you don't need a real-world risk to create a derivative. You just need a counterparty, someone willing to take the other side of a bet. And if you can find enough counterparties, you can create unlimited bets on anything, whether you own the underlying asset or not. By 2008, the notional value of outstanding derivatives exceeded $680 trillion. Not billion, trillion. 68 followed by 13 zeros. More than 10 times global GDP. Bets stacked on bets stacked on bets, with no connection to the real asset supposedly underlying them. The financial crisis was supposed to fix this. Dodd-Frank, central clearing, margin requirements, stress tests. We were told the system was safer, that the excesses had been contained, that banks were better capitalized and less leveraged than before. The data tells a different story. Derivative exposure at the 5 largest U.S. banks has grown every year since 2010, not shrunk, grown, from $41 trillion in 2010 to $67 trillion today. The bomb didn't get smaller, it got bigger. And it moved deeper into the footnotes where regulators don't look and journalists don't read. This is where the lie becomes unsustainable. To understand why $67 trillion matters, you need to understand the difference between notional value and actual risk. The banks will tell you that notional value is meaningless, that it's just the face value of contracts that mostly offset each other, that net exposure, what they'd actually lose if things went wrong, is a tiny fraction of the headline number. This is technically true and profoundly misleading. Consider a simple example. Bank A sells Bank B a credit default swap on $10 billion of corporate bonds. Bank B now has protection. If those bonds default, Bank A pays. Bank A has exposure. If those bonds default, they owe $10 billion. Notional value, $10 billion. Now Bank A gets nervous. They don't want that exposure. So they buy a credit default swap from Bank C on the same $10 billion. Now Bank A is hedged. If the bonds default, Bank B pays them, and they pay Bank C. Net exposure, 0. Notional value, $20 billion. Bank C does the same thing. They sell protection to Bank D. Bank D sells to Bank E. Bank E sells back to Bank B. Everyone is hedged. Net exposure across the system, 0. Notional value, $60 billion. The banks look at this and say, we're perfectly hedged. Notional value doesn't matter. But the hedge only works if every counterparty in the chain can pay. If Bank C fails on a Tuesday morning, Bank A's hedge vanishes. They're suddenly exposed to $10 billion they thought was offset. They sell assets to raise capital. The selling crashes prices. Bank D's collateral is now worth less. They face margin calls. They can't pay Bank E. The chain collapses in hours. This is exactly what happened with AIG in 2008. AIG had sold credit default swaps to every major bank on Wall Street. When the underlying mortgages defaulted, AIG couldn't pay. Every bank that thought they were hedged discovered simultaneously that they weren't. The government had to inject $182 billion in 72 hours to prevent a chain reaction that would have collapsed the global financial system. The lesson was supposed to be, don't let single points of failure accumulate systemic risk. The reality is, the same structure exists today, just with bigger numbers and more complex instruments. When institutions build what we're seeing in those footnotes, they're not managing risk, they're obscuring it. On January 8, 2026, the Office of the Comptroller of the Currency published its quarterly derivatives report. Page 12 contains a chart that should be on the front page of every financial publication in the world. The 5 largest U.S. banks hold 94% of all derivatives in the U.S. banking system. Not 50%, not 70%, 94%. 5 institutions, $67 trillion. This is not diversification. This is concentration beyond anything that existed before 2008. JP Morgan alone holds $58 trillion. Their total capital, the money available to absorb losses, is $340 billion. That's a ratio of 170 to 1. For every dollar of capital, $170 in derivative exposure. At 170 to 1, a 0.6% loss on derivatives would wipe out the bank's entire capital base. Not 10%, not 5%, 0.6%. The bank would tell you this comparison is unfair, that most derivatives are interest rate swaps that don't carry default risk, that their models show maximum probable loss of $4 billion in a stress scenario, that capital ratios are the wrong metric for derivative exposure. But models are only as good as their assumptions. JP Morgan's model assumes interest rate volatility stays within historical bounds, assumes counterparties honor their contracts, assumes liquidity exists to unwind positions in a crisis, assumes the correlations that held for the past 20 years will hold for the next 20. In September 2022, UK pension funds nearly collapsed because interest rate volatility exceeded model assumptions by a factor of 4. In March 2023, Silicon Valley Bank failed because depositors moved faster than any model predicted. In October 2023, Treasury market volatility hit levels that shouldn't happen, according to standard risk models. The models keep failing, the derivatives keep growing, and the footnotes keep getting longer. Less than 45 days remain before the next Federal Reserve stress test results are published on March 1st. These tests are supposed to tell us whether banks can survive a severe recession. What they don't test, what they've never tested, is what happens when derivative counterparties fail simultaneously. When the hedges that make net exposure look small evaporate because the institutions on the other side of the trade no longer exist. The Fed's stress test assumes an unemployment rate of 10%, a stock market decline of 55%, and a housing price drop of 38%. It does not assume that Goldman Sachs fails, that a European bank with $40 trillion in derivative exposure enters resolution, that the chain of counterparties that makes the system look hedged is actually a single point of failure disguised as diversification. While one side models, the other side watches. The institutions that understand derivative risk aren't the ones holding $67 trillion in exposure. They're the ones who've spent the past 3 years reducing it. Berkshire Hathaway, Warren Buffett's company, once called derivatives financial weapons of mass destruction. Their derivative book has shrunk every year since 2016. What they've bought instead? Cash, treasury bills, and physical assets that don't require counterparties. The sovereign wealth funds of Singapore, Norway, and the Gulf states have similarly reduced derivative exposure while increasing holdings of real assets, gold, infrastructure, agricultural land. They're not betting against derivatives. They're simply declining to bet that the chain of counterparties will hold in the next crisis. The trade is asymmetric. If the derivatives work as modeled, the big banks earn billions in fees, and the cautious miss out on leverage. If the derivatives fail as they did in 2008, the big banks require bailouts, and the cautious own assets that don't depend on counterparty survival. This is what a system looks like when it's optimized for calm and catastrophically fragile in crisis. The $67 trillion didn't accumulate because banks are reckless. It accumulated because derivatives are profitable. Every swap generates fees. Every structured product creates commissions. Every hedge enables more leverage, which enables more trading, which generates more fees. The incentives all point toward complexity, toward interconnection, toward balance sheets that look safe because exposures net out, while the system becomes more dependent on every node surviving every shock. Picture a circus tent held up by 67 poles. Each pole is thin. Each pole leans on the others. A structural engineer examines it and calculates the load distribution. Perfectly balanced, they say. The force is offset. No single pole bears too much weight. Then someone bumps one pole. It shifts. The poles it was leaning on now bear more weight. They shift. The entire structure oscillates. If the oscillation dampens, the tent stands. If it amplifies, if each shift causes larger shifts, the tent collapses in seconds. $67 trillion is not 67 trillion poles, but it is 67 trillion reasons why the question, what happens if one major counterparty fails, has no good answer. The models say it's hedged. The history of 2008 says hedges vanish precisely when you need them. Some will look at bank earnings and see stability, record profits, dividends increasing, stock prices near all-time highs. The market believes the banks are healthy. These are the same markets that priced Lehman Brothers at $45 per share 6 months before bankruptcy. That gave Silicon Valley Bank investment-grade credit ratings a week before collapse. That valued AIG as one of the safest companies in America, while it accumulated the exposure that nearly destroyed global finance. Markets price what's visible. Derivatives are designed to be invisible. That's their function. To move risk off balance sheets into footnotes. To transform gross exposure into net exposure through hedges that exist on paper until the moment they don't exist in practice. Others will read the OCC reports. We'll track notional exposure quarter by quarter. We'll notice that concentration has increased, not decreased, since 2008. We'll understand that 94% of risk in 5 institutions is not diversification. It's a single point of failure with 5 names. The informed are not predicting collapse. Prediction is for those who think they can time markets. The informed are simply recognizing that a system built on $67 trillion in interconnected bets has a failure mode that looks like nothing until it looks like everything. That the progression from well-hedged to systemic crisis happened in 72 hours in 2008 and could happen faster today because the numbers are larger and the connections are deeper. What the informed own is simple: assets that don't require counterparties. Gold doesn't need Goldman Sachs to survive for it to retain value. Land doesn't need JP Morgan's hedges to work out. Cash in a treasury bill doesn't depend on a chain of derivatives clearing correctly. This is not financial advice. This is not a prediction that banks will fail or derivatives will collapse. This is simply an invitation to read page 87 of JP Morgan's quarterly filing. To look at the number in the footnote. To ask yourself whether $58 trillion in exposure against $340 billion in capital seems like a structure built for resilience or a structure built for fees. The $67 trillion exists. It's not hidden. It's published every quarter in filings available to anyone willing to read past page 14. The regulators see it. The executives see it. The counterparties see it. The question is whether the assumptions that make it safe, the models, the hedges, the belief that 2008's lessons were learned, will hold when tested. They held in 2020. They held in 2023. They held yesterday. Whether they hold tomorrow is not something any model can answer. Because the models assume the system works, and when you're asking whether the system works, the system's own models are not a reliable witness. $67 trillion, 5 banks. Footnote on page 87. Hidden in plain sight, until suddenly it isn't hidden at all.